Is difference between broken period interest versus pre-EMI. Simple technique. Imagine you're borrowing money from a bank and you need to start repaying it. But depending on how and when you get the loan amount, two types of interest concepts come into play: broken period interest, PPI, and pre EMI. Let's break it down in an easy to understand way. What is broken period interest? BPI is a one time interest charge for the days between loan dispersal and the first EMI date. Suppose the bank has a fixed EMI date for all borrowers, like the 5th of every month, but your loan gets dispersed on the 20th of a month. Since the first EMI starts on the 5th of the next month, you need to pay interest only for the days between the 20th and the 31st before the EMI cycle begins. Loan types where BPI applies: home loans, personal loans, auto loans, business loans, where full amount is dispersed at once. Example of broken period interest: loan dispersal date 20th March, EMI date 5th of every month. This is a one time small charge that you pay separately before EMI starts on the 5th of April. What is pre EMI? Pre EMI is when you pay only interest on the dispersed loan amount until the full loan is given. This happens when the bank gives you a loan in parts instead of the full amount at once, like in a home loan for an under construction property. Instead of paying full EMI, you only pay interest on the dispersed amount until the full loan is released. Loan types where pre applies: home loans, under construction, loan against property, dispersed in phases, project finance. Example of pre-EMI: you take a home loan of 50 lakh rupees, but the bank disperses only 10 lakh rupees first. Instead of full EMI, you pay interest only on 10 lakh rupees every month. Once the bank gives you the full 50 lakh rupees, the actual EMI starts. This continues for months or years, depending on how long the full dispersal takes. Key differences at a glance: feature broken period interest, PPI, pre EMI, interest for extra days before EMI starts, interest paid only on partial dispersed amount, one time charge before the first EMI, repeats monthly until full loan is dispersed. If loan disbursal doesn't match EMI date, if loan is given in parts over time: home loans, personal loans, auto loans, business loans. Home loans, under construction, loan against property, project finance, small extra payment before EMI cycle starts. Longer pre EMI means more interest paid in total. Simple trick to remember: broken period interest, PPI. One time small charge, paying rent for a few extra days before the lease starts. Pre EMI, ongoing interest payments until full loan disposed, like paying rent in stages before moving into a fully constructed house. Please like and subscribe the channel and share it with your friends and family.